I don't know if you're my favorite attorney, but you're one of them. Now that being said, I don't like most attorneys, so it's a
You're too,
low
you're
bar.
too kind. That's a great way to start. That's a great way to start.
Okay, we'll give everybody a
Oh
quick
man.
intro, Josh, of who you are and what you do.
Yeah, absolutely. Well, I appreciate the introduction here, Ryan. So I'm Josh Lowenthal. I'm an M&A and tax lawyer, really tax lawyer by trade. And so what I specifically do is I work with small and medium-sized businesses, helping them tax plan, tax structure, save money as well as they possibly can, as well as work alongside other M&A attorneys on um, structuring and helping buyers buy companies and buying them tax efficiently and helping sellers sell their companies tax efficiently so that they can put more money back in their pockets.
Okay, so the first time I came across a tax attorney, actually used one. I had bought a company. I bought it from my father, and so we found out. And I say that it wasn't. There was no. I was running the company, so we found out we owed sales tax. We just didn't know that. Like we'd been
Yeah.
paying it, so it wasn't like a hidden thing. But that's the first time I come across a tax attorney for paying that in New Mexico. I think we used them for. Anyways, so explain maybe if you're not familiar with a tax attorney, like why do you need a tax attorney for versus your CPA? Like when do they come into play? What's the benefits and pros and cons of a tax attorney?
Yeah, a really great question. And this is a really common misconception that we see in the space all the time because people hear, oh, well, I need a really good tax accountant. Oh, I need a really good tax lawyer. Oh, this person is a tax consultant, right? And really, what are the key distinctions between all three of those categories? Um, Generally speaking, the biggest difference, of course, is our backgrounds and our degrees. Accountants are going to be have a lot of education, a lot of background in terms of finance. They're going to have taken the CPA exam, right, or an enrolled agent exam as well. Like what we, whenever you see that EA designation, they are fantastic. I don't want to forget about EAs in our space as well. Accountants are for uh, modeling, right? They help run Excel models, plan out, okay, this is how much we think you're probably going to owe in taxes based off of the profit and loss statement, based off of your balance sheet, based off of the proposed sale. Accountants are also very good and are necessary for compliance, right? They're the people that make sure that you are filing your payroll taxes on time, that you are filing and remitting sales tax, right? So that you don't run into issues, or that you're filing or your company is filing your income tax returns. And so that's accountants, right? They're your number people, they're your number crunchers, they're your compliance people. Tax lawyers, on the other hand, and this is where I think the misconception comes in, do something a little bit different. So we primarily help with the law. So there's this massive body of law, we call it the Internal Revenue Code, and that is what um, gives us the gray areas to help advise businesses on how to save money on taxes. So what we do is we look at the tax law and whenever we have a business come to us and we say within the bounds of the law, these are the things that we think you can do to save money on taxes, and these are the things that we think you can't do to save money on taxes. So the real life example that we come across with small business owners all the time is something like QSBS or Qualified Small Business Stock. Not going to give everything away right now, but the short version is that there's some key requirements that are necessary to be met before somebody can exclude income when they sell their company. We are the people that go in and make sure that A, you qualify as for the qualified small business stock, and B will help you run the analysis or give you other options in case you don't. The accountants, on the other hand, are the people that are going to file that tax return and run the numbers to help calculate how much in true tax savings you will have. Oh, and may have lost you there. I don't have any audio here, Ryan.
Oh, I'm back now. Sorry, I was muted. So
No, you're
I
good.
said
Hey,
maybe in the
all
edit.
good,
I don't
all
know.
good.
I don't know. We'll ask at the end what you're going to talk about in the exit ready intensive. So maybe some of this, maybe not. But just from that kind of phrasing there, if you're an owner, you're going, okay, I never even heard this term. How long? I've tried to ask the speakers and presenters, like, how long do you need to think about exiting to understand this? Like, if they call you today and say, I want to sell like closings next Friday, is this something that can be done in a week? Is it like years? How long do they need to have to set this stuff up?
Yeah, uh, the getting the call from a seller saying, "Hey, I'm looking to sell in the next 3 weeks, right? We're closing," is the phrase that gives every single lawyer, every single broker, every single accountant like immediate heartburn, right? So for me as a provider, ideally, in an ideal world, I'd love to have somewhere between 3 to 5 years. Now, I know that's not always pragmatic. That's a long time horizon, and so. If I have at least right 6 months, 6 to 12 months, we can at least start to map out a plan and identify, okay, here are some of the potential planning opportunities. Here are some of the potential pitfalls that you could be looking at that could actually reduce your purchase price. And so let's identify those, let's address those so that you are in a better position when you go to market. So 6 to 12 months, ideally, though, the more time we have, the better, because some of these planning opportunities uh, have built-in timelines, right, and statutes of
Yeah,
limitations before somebody qualifies.
yeah. Okay, so you're the attorney here, so I'm just going to ask the generic dumb question. I think of businesses, you got
Yeah,
the sole proprietor. We're not talking about that, right? We're talking about companies. So LLC, S corp, and C corp is kind of the three main things I think about. I'm guessing in the world that we operate in, C corp has really not come up a lot, or does it?
in terms of the sales side or the buy side.
No, no, like current operating under a C corp.
Yeah, yeah. Oh, yes, yeah. So in small, medium-sized businesses, we don't see it a ton. And a lot of it relates back to history, right? So we had new tax law back in the 80s, right, when Reagan was president. And at the time, there was the tax law and where it was set up is that there was a very high corporate tax rate and the dividend rate was much higher as well. And so there were a lot of companies where it just didn't make sense to actually be structured as a C corp because you were giving half your paycheck and half of what you earned away to Uncle Sam. Um, so the short answer is that we don't see a ton of C corps or older C corps, right? For companies that were formed in the 80s, 90s, early 2000s. Really beginning in the early 2010s and now more frequently, they're starting to crop up more, largely because the corporate tax rate following 2017 has dropped to 21% and the dividend rates are much more competitive. Um, which is really just a long way of saying the vast majority of people that we see will either have LLCs that are owned by one person that are disregarded for federal income tax purposes, or they will have a C corp or C corporation that they've elected to be taxed as an S corporation, which is that special tax designation that allows a single layer of tax. It is most frequently what we see. But spoiler alert, and I'll kind of preview this for you and all the listeners as well, is that a lot of times there are S corporations that did not follow the rules, and so they may actually be C corporations in hiding.
Yeah, yeah. So, okay, that's where I was going to go. I'm glad you brought that up. So, let's say that you are electing to be an S corp. You're thinking about an exit. You want to make sure that you've followed the rules. If you haven't followed the rules, can you get back on track to make sure that you're following the rules? Is this something that can be done retroactively, or once you've messed it up, it's messed up? Like, what needs to happen from a standpoint of if you're listening right now, going, "Oh my gosh, I didn't even know about these S corp rules. I just checked this box and filed taxes this way."
Yeah, yeah, it's a great question. And I'm gonna give you the lawyer answer that everybody loves is it depends. It depends on what you did. Um, so there are some things which hopefully this calms some people's nerves, but there are some things that you can go back and correct. it used to be the case that when you had an S corporation that was what we call an inadvertent termination, right? They didn't follow the rules. They had a wrong type of shareholder. They made distributions that were not pro rata, etc. Right? You actually had to go to the IRS, spend lots and lots and lots of money to ask the IRS for an opinion specific to your company, saying, "Hey, can allow me to go and correct this." Now, the IRS at one point, at the height of this, was processing something like 30,000 requests a year. I mean, a lot of requests. And so they've given us some guidance to allow business owners to go back and correct some of these minor issues. So it's a long way of saying, even if you have messed up, depending on what exactly you've done, you may be able to go back, correct for it, and document your file and be protected.
Well, and I think from my perspective, the reason we're talking offline, I'm putting on this intensive is for owners to maximize their value when they exit. And this is something that can really mess it up. Like if you haven't done this right,
Yes.
then it could mess it up late in the process. People go, oh, wait, hold on. This is not, when it transitions, it's going to be a C Corp or whatever's going to happen. I got a guy right now and he's worried about contract labor staff. And so he's having his attorney review, make sure that none of those are actually W-2s. And so M&A has been treated as a game where you want to get a broker or an advisor and you want them to do the work and bring me an offer. It's like no, there's a lot of money on the stake on the table here, and so making sure that you have this set up right is the best. It's going to cost you money, but it's also the way that you maximize your value and you don't come up to the finish line and go, oh no, I could have fixed this, or I should have fixed this, or I couldn't have fixed this, and I need to know that before I want to sell. Now it changes what I want for valuation or how I'm doing stuff and or the tax bill. And so I don't think a lot of owners understand that. I'm sympathetic because I don't understand how to run a roofing company. I'm not a roofer, so I'm not. It's not disparaging. It's like there's so much that goes into this that if you don't do it right, you're just leaving money on the table, or the deal won't happen at all.
Yeah, absolutely. I mean, and I think that is hitting the nail right on the head. When I work with buyers on the buy side in a tax counsel capacity, the very, very first question I ask is the target an S corp? And if it is, then I have a whole set of questions that I begin working through and documents that I want to see to make sure that the seller has a valid S corporation. And so, and if they don't, what that leads to is a couple of different things. Either one, it's going to cost the seller more money because they have to go and restructure their company now in order to sell, right? Or alternatively, like they have to restructure the entire deal. Maybe they thought they were doing a stock sale, which is very good for sellers, but now have to restructure into an asset sale because the buyer realizes, gosh, I'm not getting what I thought I was getting. So it's all to say, as corporations, if not addressed early on in preparation for sales, right?
Yeah.
And you don't go through and you make sure that like everything's in place, then it easily and very quickly becomes one of the things that a buyer will hone in on very early on
If they're
and
smart,
could
if
ultimately,
there's
yeah,
yeah, because they don't want
yeah, if they're
to.
smart.
Yeah, yeah, if they're smart. And that's what you want. You actually want smart buyers. We're talking offline again about owners. We're trying to educate owners to understand that, okay, if you think about like fast food, if you want the buyer for the McDonald's burger, which I love McDonald's burgers. I'm a fat guy, so I like burgers. But we understand that customer base, okay, that they got the Happy Meal, the dollar menu, versus like, the Five Guys or the In and Out or whatever the top line burger chain is. It's just a different buyer that's regularly going to consume that. And so when you go to sell, what you want to do is sell to the buyer who has the most money and will pay the most, and it's a different tier. And so if you sell to a buyer who's not concerned about this S corp election and will it transfer right or not, they're probably not going to give you the most money because they don't understand the risk that they're incurring, right? So if they don't understand the risk, then I mean, unless they just got, it's a billionaire's kid who's just writing checks, they don't understand what they're going to do and probably going to give you a lower valuation than you actually deserve.
Yeah, yeah, absolutely. And it's counterintuitive, right? At the end of the day, because you want, and I think this is the point you're really honing in on here, right? Like you want somebody who's going to ask those hard questions. that a buyer who is going to run due diligence on you as a seller, that is going to address these questions about you as if your company is structured as an S corporation, because those are the business buyers that are really savvy. They're going to be strong owners when they take over. And most importantly, when we think about it, and this is the thing I advise sellers on whenever I'm counseling them, right? Is that selling is a very emotional process as well for a lot of business owners, right? You've built this company over 10, 15, 30 years, and you want to make sure that the legacy that you've created is going to be carried on in a fashion that matches the core philosophy of that company. A strong, intelligent seller that knows what they're doing is not only going to give you more value for your company,
Hmm.
they're also going to make sure that they're preserving your legacy in the long run as well.
Well, and which leads me to my next question about earnouts. And so, if you're going to structure a deal where you get an earnout, there's tax implications there. But also, going back to your point about a strong buyer, if you're going to do an earnout model, you're going to want the buyer to be as strong as possible, so that way you have the highest chance of getting your earnout, right? So, if you have a, we'll call them a less
Yeah,
sophisticated buyer, not being disparaging, but a less sophisticated buyer, then the earnout, I think I got a stat. It's like 21% of earnouts get paid out in full. It's not very many. So if you want earnout and that's part of your retirement package, then you want to have the best buyer possible. And if you take all cash, then you're going to get a lower valuation. So it's a game. It's a game that you have to play
yeah,
very well.
yeah. No, and that's exactly it. Like you have to play the game well, and at the end of the day, and kind of looping us back to where we started as well. Like the better prepared you are, and the cleaner your company looks as you prepare to exit, kind of we were talking offline, like you have the things that are necessary to actually be a business, right? The business can operate without you if you step out for 30 days, right? That there are systems and there's processes in place. Then in addition to having all the legal tied out, well, then you're going to have a higher valuation. And you know that when the buyer comes in, if you do negotiate for an earnout, you're more likely to get that earnout too.
And
And
from
for a
a, I
lot of
don't,
sellers, oh,
no, go ahead, sorry. And for a lot of sellers, you're saying.
oh no, yeah, all I was gonna say is like for a lot of sellers, that this is the first and only sale they'll go through.
Hmm.
And so if this is what you're retiring on, maximizing what you earn, both in terms of true dollars, right, cash at close,
Hmm.
and how much you save on taxes is just critical.
Yeah. And obviously each person's different. You're a lawyer, insert caveats here. I know how you are, which is why I
Always,
like dealing with you.
always.
So if you're just at face value, if someone calls you up and says, "Hey, um, I can get 5 million today cash, no earnout, or I can get 3 million today plus a $4 million earnout, so 7 million total over the next 3 years, we'll say." Like how conceptually do you just start that conversation? Not setting aside the risk of getting the earnout, just from a tax standpoint, how should owners even think about that?
Yeah, that's a tough question. Just to be candid with you, it's to me that really becomes a business question, less so a tax question, right? Yes, you're gonna with the earnout structure, you take a little bit less upfront. Some of this is also very context dependent, right? On how you sell the company. Because if we're looking at, say, an
Yeah,
asset sale with
yep.
an earnout,
Yeah, why
the
don't you
way
pause right there, maybe, and explain the two major ways you think about selling assets and equity, just so people can understand before you fill that in for them.
Yeah, yeah, yeah. So I guess some background here, right? There's generally two ways that you can sell a company. We'll talk about the other third hybrid way as well, during everything. But two general ways is to either sell assets or to sell stock. Most sellers prefer to sell stock because you are taxed at lower capital gain rates as opposed to the higher ordinary gain rates. Whereas if you sell assets, right, you're going to be taxed at really a hybrid rate. which gets into some of the legal wonky um, areas of selling. So we're not going to go in there. So that's kind of step number one of the analysis, right? Is the sale a stock sale or an asset sale? So say you take 5 million in cash up front, but that's an stock sale. Or alternatively, right, you can do a $4 million cash up front, but a $3 million earnout, and that's an asset sale, or flip them. Your analysis is going to change depending on number one, the structure, right? But there's also a business decision involved here too, which is um, how likely is it that you're going to get that full $3 million? Because from a tax perspective, from an accounting perspective, from a business modeling perspective, you have to, there's the present discount value of a dollar, right? And so is the $1 million that you earn, extra $1 million that you earn today in guaranteed cash worth more to you than the potential $3 million less taxes that you could earn in 1 to 3 years? So I
Yeah,
know that's
well,
really in the weeds there, but
no, no, it's great because it's great because some of the advice, and I get it. We were talking a little bit about this offline as well. We talked a lot offline, so I always love talking to you.
yeah. Well,
But
we're friends, so it works out.
but no, it's there's so much there's in social media you have to say things, right? You have to say things just so people can follow you, they like you. But the real world, there's so much nuance, and especially in M&A, there's so much nuance that has to go on. Each deal is unique. And there's certain guidelines and principles that you kind of follow, make sure best practice is legal, like make sure you're not breaking the law. There's stuff like
Yeah,
that. But at the end of the day, there's a ton of negotiation and stuff. And so when you said, well, you got to think, how likely is the earnout? And kind of what I've advised owners on is set your top priority first. Like, what is the best, highest thing that you think? Is it most money? Is it the fastest close? Is it the most earnout? What is the number one? Keeping your employees the longest? Like, what is that? And if you have that, and you kind of walk through this process and you refer back to that, that gives you the best ability to go back and say, okay, you know what? I said I wanted the most cash at close. That's what I actually said. So I could have gotten this $3 million earnout, or you might say, no, I want to have a big earnout. I've got plenty of cash. I really want that second bite of the apple. I got a good team. So but if you don't start with that kind of end in mind, almost the end after the end, in this case, whether you want the earnout or not, then you can find yourself torn because you can be pulled in a lot of different directions over what's next because and we're not going to talk about this on this call, but there's non-competes you got to sign. Like, so
yeah,
when you say it's your probably your one shot, unless you're going to wait like 5 years, it is your one shot. Like, and you're going to go back through this process again. And so, um, it that's what I've come to learn is just advising people like what's your highest and best case scenario, and then you can make a list of 2, 3, 4, 5, 6, whatever. But understanding that because if you don't understand that, then the question of the earnout and the taxes, the value of the dollar, because you might think, hey, the economy's going to crash and this thing's going to fall apart. Well, if you really believe that, then the earnout's probably not the way to go, unless you're in that kind of a business that makes money in those super tight recessions. If you think, no, we got
right.
15 years of prosperity, then the earnout might be the way to go. So you got to really think through that. And the earlier you do, the better odds of success you're going to have in this process from a tax standpoint, from an M&A standpoint, from all of these standpoints. And owners, it seems, are they're pulled in so many directions that these are the questions that they need to really be answering earlier in the process. You mentioned 1 to 3 years. I think all of the guests that I've talked to that are going to do the coaching sessions have kind of said that same timeline. And I haven't asked them to say that. I've just asked what's their opinion. And it's really weird. They all
Yeah,
say 1, 3, 4 years, something like that, because this is a major life shift that's going to change so much about who you are and what you do and how you can earn money that um, it kind of gets swept under the rug. And do you think that with the influx of all the talk about the SBA program and all the buyers coming to market, that sellers aren't getting educated because we're trying to feed the buyer pool? Or why do you think that is that owners aren't really getting this education early on?
yeah. I think it's probably a split of a couple different reasons, and this kind of gets into a comment that I wanted to make on what you were just talking about, right? Where the devil is really in the details here. right? Like it's easy to go online and look at Instagram or look at TikTok or YouTube, right? And see like broad proclamations. But it's you really have to get into the nuances of your particular deal to really define like where can we provide the most amount of value, right? And that really kind of leads me into why I think we see such a large pull and amount of information for buyers as opposed for sellers, right? Which is where are we speaking? A lot of buyers tend to trend, and admittedly, I don't have the data behind this, but it feels like a lot of buyers tend to trend younger. We're seeing more and more MBA programs that are have these ETA programs, right? Or courses. And ETA, for everybody that isn't familiar with that phrase, is entrepreneurship through acquisition, right? SMB is small and medium sized businesses. And so we see these programs that are gearing um, potential buyers and operators towards going and buying a company. And so they're speaking on their platforms, right? They're speaking on LinkedIn, they're speaking on Twitter, they're speaking on Instagram or TikTok. And a lot of sellers, if they've been in the marketplace, right, they've been out grinding it out for 10, 15, 30 years, that's just not necessarily where they might be. And so as a result, you end up with a two-pronged issue here, at least in my opinion, right? Number one, for the people that are promoting, it's easier to loop in buyers than it is to loop in sellers, right? But number two, they're just not speaking on the same platforms that a lot of sellers or in the same spaces, right? As a lot of sellers tend to end up. Um,
Yeah. Well, and I've worked with buyers, and you've worked with buyers, and so this is where it becomes quite hard because some of the buyers I've worked with are, very sophisticated. One's a current business owner looking to buy a second business and decided, no, my deal is really good, and so for him, it was okay. Well, I kind of learned, and I worked with some buyers who were like, oh no, I want to go through the ETA process, and that's a different buyer. That's a different mentality. Uh, but you got to understand that um, the good news for sellers, I think, is that there is so much interest here that it makes it more competitive if you know how to position your company, right? Because some of those
mhm.
buyers are going to want to buy the 100% owner finance, needle in a haystack type thing that you can't find anywhere. But those smaller, we think PE, we think big PE, flashy, but there's a lot of small PE groups that you never even heard of, right? There's a bunch of them, and so but it does make it a little bit more
Yeah,
competitive. And
all over
yes,
the time.
yes, and so it does make it a little bit more competitive because you might find some operators who are, running companies now looking to get to this ETA space, and so it has, to your point, there's a lot of education going on in that space, and it's not that the seller wants to be um, an adversary against that space. It's just understanding that the buyers are getting a lot of education on how to get this, and if they understand this stuff, they understand how to potentially lower the valuation or get a better deal, maybe we might say. And what I don't think I see a lot of is sellers. It's okay if you want to sell to one of those buyers. That's fine. Nothing wrong with that. But there's also other buyers that you can sell to, and there's a lot of ways. There's a lot there's a lot of ways to do this thing, and it kind of gets narrowed into the ETA space as you mentioned. And it's like no, there's a lot of ways, strategics and all kinds of stuff that you can go to.
Yeah, the marketplace is massive, right? I mean, the marketplace is massive. Like you do see these small concentrated communities on the various social media networks, right? But for every five people there are on social media looking to buy or potentially looking to sell, there are 15 others that you've never heard of that are going to your local networking group, or they're in your Kiwanis club, or they're at your other local social club, right? And you don't even know. And I think on the other side of that coin, right, for sellers, there are so many people out there that just don't even realize that it's an option, that they can turn around and sell this to somebody else and walk away with their inheritance, right? And the story I'll share with you is I was talking with a guy local here in Alabama. I'm based out of Alabama these days, despite being a fan of another team much farther north. Um, eh, Nice guy, right? Started his company from scratch, right? Himself in a truck. He was in HVAC. He has now grown his company to like three to five trucks, 20 plus employees, servicing all of central and northern Alabama. He does 2 point something million dollars a year in revenue, right? Which after EBITDA, applying a multiple, I mean, it's a nice cushy exit for him. He's owned the company since 1980, didn't even know it was an option to sell. Didn't even know it was an option. And now we're working together because he unfortunately doesn't qualify for QSBS. And so we're going through some other options to help make sure that he can restructure the company in a way that puts more money in his pocket so that he's not giving the vast majority away to Uncle Sam when he actually does sell in the next year or two here.
Yeah. Now, and yeah, it's a thing to where it's a high stakes game, and what I try to tell sellers a lot is, you know, think about risking millions of dollars to buy your business. Like it's like think about that. You want to make this as bulletproof as you can, so that when they buy it, they feel like, okay, I've just wrote a check for 2, 3, 4, 10, 20, 30, 40, whatever it is. They feel like, okay, I'm going to get back this plus a return on investment, just like you expect out of your employees right now. And so the less steps you take to make your business exit ready, just use that term, then the lower the valuation is. And so it's a process that as you mentioned, there's older owners. I remember when I was first running the company that I mentioned a minute ago. We were approached to be bought by strategics twice. And the first time, one company was trying to buy up a bunch of strategics because they were going to go public. And so that was their plan. And we walk in this meeting, and they said, "What's your EBITDA?" And we're like, "Uh, never even heard that
I have
term,
no idea.
EBITDA." And so we
Yeah.
called the CPA on the way home, what the EBITDA was. And they kind of halfway explained it to us. But, it's like, I don't know what that is. And owners, I don't expect owners to know what their EBITDA is unless they're thinking about selling, because it's not even relevant to their day to day life
No,
99% of the time.
well, and that's the thing, right? If you ask an owner, "Hey, what's your EBITDA today?" Like,
Yeah.
if they know, right, then they're not doing their job,
Yeah.
right?
Yeah.
Which is running their business. But on the other side of that, and I think this is what is really important, and what you're picking up on when you talk about making sure that the seller's exit ready, is that
Hmm.
on the buy side, a buyer and specifically their provider's job is A, to protect them, right?
Yeah.
Want to make sure that the contracts are drafted right so that if something goes wrong, the person that's paying is the seller, right? But more importantly, their job is also to poke holes in the target to figure out, okay, where can we potentially renegotiate? Where can we reduce the purchase price and still walk away with a great deal here? Because we know that, well, there's an issue with employee classification, or there's an issue with sales tax, and we'll say, cool, we'll take your company, but we're going to ask for a dollar for dollar reduction in the purchase price because you have, right, $500,000 worth of sales tax that's gone unpaid. Well, cool. Seller is now $500,000 less wealthy. Buyers walking out with a steal, and buyers happy, sellers disgruntled in the whole process. So if you can identify and make sure your company is bulletproof ahead of time, you don't run into those problems, and you're going to get a higher sales price because of it.
Yeah. And I guess one thing that comes to mind here is we talk about they're trying to poke holes. If you go buy not a new vehicle, but a new vehicle to you, a used vehicle, you want a Carfax, right? And that wasn't around.
Yeah.
You used to have to pay for that. There's no Carfaxes, but in M&A, you had to kind of build a Carfax out. You get this person to help you here, this person to help you here. And you kind of build out your own unique Carfax. But that doesn't exist. It's not like there's a business fax you can just go buy and say, "Oh, cool, this is great, never been wrecked." You got to go do all that work. So the buyer has to do all that work. You can't really. Subscribe to a platform and get that. And so, with that being said, if you think about going and buying a used vehicle, you would demand a Carfax. You would demand this. And so, if you're going to sell a car, you're going to probably, if you want to sell it, provide the Carfax, unless you've had a bunch of wrecks. and then you might want to hide it. But
Right.
if it's a clean
Right.
record, you want the Carfax. So it's the same kind of mentality, except that that one tool that we all used just doesn't exist, right? And so in this, we're saying, okay, hey, to make it bulletproof, if you will, you want to go through and to check as many of these boxes as you can as early as you can, so that you know, okay, when I go to sell, they're going to ask about this, they're going to talk about this, they're going to want to know about this. And if you don't know they want to know that, you might be offended by it, right? You might go, why are
Yeah.
you asking this
Yeah.
question? And it's what they're supposed to do. It's what they're being advised to do.
Right, right. No, exactly. Well, and you, yeah, I chuckle a little bit because you said like we don't have that tool. We do. It's called due diligence, right?
Okay, I
Which
mean, you can't go buy it for like $49 off the
yeah,
internet.
no, 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 exactly, exactly.
Yeah.
You can't go buy it for 49 bucks. Unfortunately, I wish we could. I wish we could. But no, that is the point, right? Where if buyers are going to come in and they're going to come in with a little being a little bit more savvy. And so they're going to come in and ask questions that sometimes might feel really personal. And if you as a seller are not prepared for those questions, exactly to your point, Ryan, like you might be offended. You're like, well, why are you asking that? Like, I'm not going to tell you that. But if instead, and this has always been my opinion, if you as a seller can come in and you are prepared for the sale, then you have everything ready. And when a buyer comes in and says, cool, we have 30 days for due diligence, right? Due diligence, for people that don't know, is just that process of looking through the business and looking in all the nooks and crannies to figure out, okay, like where are there potential issues? But if you as a seller can come in and be like, okay, here is everything that I have that I'm anticipating that you're asking for, right? Their due diligence process is going to be so much cleaner, so much quicker, right? And they're less likely to find problems because you're prepared. And what does that ultimately lend to? Well, it leads to an easier process, less legal fees, and more money in your pocket.
Okay. I got this from someone else, and it's in a book. I got to find which book it was so I can give the person credit. But
Yeah.
they advised, I love this mentality that you, if you're an owner, every 90 days you should consider if you're going to sell your business or not. And the point wasn't go through all this process of getting it ready to sell, but just that mentality of I'm going to sell or not, I'm going to keep going or not. And if we go back with history over 6 years, a lot's changed, right? And I like that mentality
Yeah.
because if you go, okay, hey, no, I don't want to sell, but if I were going to sell, I need to fix this. And so it kind of helps you make sure that you're always tweaking what you need to tweak. So if you do want to sell in the future, you're there. Now, from a tax standpoint, I don't know, like how 90 days might be, you might say, well, once your tax stuff's in place, every 90 days is a little bit much. I don't know. How would you think about that from a tax standpoint? Go ahead. Sorry.
Yeah, yeah. So there's different schools of thought about this, depending on who you talk to, right? There are, and this might be controversial, right? But there's some people out there that build themselves as like these tax planners, who ultimately are fantastic in doing what they're doing as long as you're actually like looking underneath the hood and you're not just going to your standard playbook, right? And and what I mean by that is like there are some planners out there that will say, look, we got to look at your business every 90 days, right? So once a quarter, looking at how much money you are projected to owe given your current amount of money that you've made year to date. And we're going to make adjustments for the upcoming year. We're going to have you rent out your house, right? Something called the Augusta rule, which I'm not a huge fan of, but it's still a tool that is available in the right circumstances. I see you chuckling there, but
I rent
you're
my
on
house
mute.
out all the time. No, I'm joking. I'm joking, IRS. I'm joking. I'm joking. I'm joking.
Yeah. So, um, but it, I'm kind of giving you a very long, convoluted answer saying if you're looking at your year to year tax fluctuations, reviewing your company every 90 days is a great strategy, right? Because some businesses are seasonal, some businesses, sometimes you're going to have really profitable periods, and then we're going to go through the whole US economy is going to have a slowdown because there are tariffs or there's recessions or there's a trade war or there's something else that some outside external factor that changes your business. And so you might be putting a lot away for taxes that you don't need to. Let's put money back in your pocket, right? But in terms of the broad scope or 30,000 foot view of selling your business, um, reviewing once a year is probably okay. Which gets back into my original point where if you're thinking about selling, the changes that you have to make within the business are large. They take time, right? And by time, I mean they take months to begin to implement. And so reviewing every 90 days is probably overkill in that sense, right? For a big sale, but it's still incredibly useful for the month to month, year to year fluctuations in terms of what you owe in taxes.
Yeah,
So I'm
and I
answering
think
you yes and no at the same point.
well, and I think just to be clear, I think the point wasn't go through the exhaustive process every 90 days to see if you want to sell. Like, just ask yourself the question every 90 days: Do I want to sell? And if no, then improve the business for the buyer for the day that you do say yes. And if you wait too long, then you're like, oh, I want to sell, and it's like, oh well, all these things. Then,
Yeah.
sorry, I got allergies. All these things we talked
No,
about
no, no, you're good. You're good.
yeah, yeah, all these things we talked about are now an issue. And so just kind of have that mentality. So taxes, preparing to sell, not going through the exhaustive process. I'm with you on that. Okay, so last question
Yeah.
for you.
Well, and
Go ahead. Go ahead.
all I was going to chime in there is that it doesn't, these changes don't happen overnight. It's like people use the example of like a cruise ship, right? You're piloting a cruise ship. To move your business to a place where it is sellable, there's a lot that's involved in that. To record all of your processes, you're not going to record all the processes of a business in 6 weeks. Like you know that, right? You advise small businesses on that all the time. And so it's good to review and check in with yourself every 90 days. It keeps you on task while understanding there's a long process here.
Yeah, and
With that,
well, I was gonna say one thing you said is to make it sellable. I'm a free market capitalist. Anything can be sold. It's just will it be sold for the right
sure.
that the value that you want for it? That's a different question, right? So you go, oh,
Yeah,
my business
yeah,
is sellable. Yes, it can be sold to anyone if you have the right marketing and exposure. You can sell it, just not for the money that you want. That's a different set of questions, right? And so people say, well,
yeah,
it's not sellable. It's like no, it's always sellable. It's just is it for $1 or for 10 million? Those are different. That's a different set of questions you got to answer. So give people a
yeah,
preview
yeah. Great point.
of your session of what you're going to cover, and so if they attend the Exit Ready Intensive, what they're going to hear from you.
Yeah. So really, what I'm going to be doing in my session is looking at the converse of the buy side, right? So I'll start to look at, well, what are some of the things that a buyer is going to want to look at from a tax perspective, depending on the industry that you're in. So what that might include payroll tax liabilities, that might include sales tax, something called nexus, right? Are you selling into other states, and do you have a requirement to pay taxes to them or pay sales tax to them? A lot of businesses may be selling in other states and don't even realize that they have this problem. In addition to that, I'll also look at some of the high level structuring involved in selling your business. So we'll briefly discuss QSBS, which we talked about at the very beginning of our session here. We will talk about some of the different tax selections that a buyer might present you with and whether or not you want to consider those or not. And then finally, we'll kind of tied in with all of that are F3 organizations, which again is a strategy that a buyer may ask of you if you are specifically taxed as an S corp or your business is taxed as an S corp. So
Okay, very good. And where can people
there's a lot of
find you?
material to cover. We might not
Uh,
get to it all.
okay. Well, where can people find you if they want to connect with you and hear more about your the exciting world of taxes?
Yeah, of course. So you can always connect with me on my website, joshualowenthal.com, not to be confused with joshlowenthal.com. Otherwise, I'm also incredibly available out on all the major social media platforms. So specifically, you can come find me on X at Joshua Lowenthal, first name, last name, or over on LinkedIn as well.
Yeah, and I will close the loop. I said by you're one of my favorite attorneys. I remember sending you. I won't mention the guy's name, but I sent him to you a year or two ago. I don't know, and you told me that, yeah, I can't really help this guy. And I thought, okay, there's an attorney that I can trust that I sent this guy to him, and he goes, I can't help him. And he had some tax because he already had good tax advice. Like you said, what he's doing now is as good as it could be. As far as your perspective was, I thought, okay, I really appreciate that because if I send someone over to you and you don't think you can help them, you're going to tell them. And some attorneys and people will just say, "Oh, cool, yeah, we're gonna, take a bunch of money and then not do a lot." So I do appreciate your work. I think you do have high integrity, and so it doesn't go unnoticed from this side of the table.
Yeah, well, I really appreciate you saying that, Ryan. And I guess not to undersell myself at all here, but I will also tell you that the biggest misconception that people have with taxes is that that we have silver bullets,
Yeah,
and a lot of times we don't,
yeah,
right? Like a
yeah.
lot of times, like these are things that we know are true based off of the law, but there are no silver bullets. There's no magic pills here. Sometimes other people will have the best advice, and I'll just tell you straight, because I think that's the most important thing.
Awesome. Well, Josh, I'm looking forward to it. And prediction real quick: Michigan makes the playoffs or not?
I wish. I don't think the Patty's
Okay.
gonna go for it.
Okay. All right. No playoffs for Michigan this year. Well, it was good talking to
No.
you, bud. We'll talk soon.
Yeah. Thanks so much, Ryan.